learned from Graham and Dodd has served me well, but I came to realize that I had remained anchored for longer than I should have to their tight focus on the importance of balance sheets, book value, and current cash flow or earnings. While my evolution as a value investor began with Graham and Dodd, my continuing education in the real world fostered a more nuanced understanding of value. For example, as my career progressed, it became clear to me that many of the better businesses in the world hardly ever trade at a discount to book value, let alone below net working capital, and many of these businesses never seemed to sell at a low multiple of current cash flow. While Graham and Dodd got me to focus on the price paid in comparison to balance sheet metrics as the essential arbiter of downside protection, I've come to appreciate that the substance of a business, things like its competitive position, its profit margins, and its growth rate, has greater importance. I also came to realize two other things. One, an assessment of a business's value that includes both its current and estimated future earnings could also provide a valuable margin of safety for the investor. And two, a seemingly inexpensive business with significant current earnings and apparent balance sheet protection could nonetheless prove to be an unattractive investment if its basic business model is disrupted. Many investors tend to think of value investing as the practice of owning the shares of humdrum established businesses, often those in cyclical industries that are not experiencing much growth. Conversely, they consider growth stocks to be those businesses that can grow at a vigorous rate for years while experiencing limited economic cyclicality. But I've come to appreciate that there is not a bright line that divides growth and value. Value can be found in rapidly growing businesses, and growth can be found in what appear to be more traditional value investments. Philosophy. Rather than relying on labels, investors need to have their own philosophical paradigm to help frame opportunities and make more productive the quotidian work that occurs day to day. Otherwise, as to paraphrase Lewis Carroll's Cheshire Cat in Alice's Adventures in Wonderland, if you don't know where you are going, any road will get you there. I call myself a value investor, but that label does not offer a clear-cut definition. The growth investor presumably believes the companies they own are of value as much as a value investor does. My approach is to commit capital to an opportunity when the risk of losing money is limited, while at the same time there is asymmetric upside potential. I am philosophically aligned with those investors genetically predisposed to not losing money. The whole point of having a margin of safety is that even if everything doesn't go according to plan, investors may still come out close to whole. My firm's approach is to seek out good quality businesses at a reasonable price. We assess quality in terms of such attributes as a business's return on capital, the defensibility of its market position, its pricing power, the caliber of management, and its growth potential. Holding a concentrated portfolio of shares in good, growing businesses for longer periods is likely to be more beneficial than holding superficially cheap securities in inferior businesses and trading them frequently. Indeed, a benefit of owning a high-quality business with favorable growth prospects is that the shares can be held for many years and the business does the work of compounding investors' capital. For taxable investors, this approach is a particularly tax-efficient one. Investors are best off when they can maintain a longer-term time horizon. I consider time horizons of 5 to 7 years to be a typical market cycle. This can help investors avoid the poor trading decisions that become commonplace in periods of high volatility. A short-term orientation, generally rooted in what I regard as an illusory belief in being able to time a market, can distort thinking and distract from long-range investment goals. Longer-term success requires accepting periods of underperformance. An investor must maintain the resolve and staying power to avoid market fads and bubbles. There are no shortages of these. Recent examples include the whimsical valuations found in the tech stock internet bubble of 1997 to 2000, the housing bubble and associated subprime lending that reached its zenith in 2005 to 2007, the overreaction to COVID-19's impact in 2020, and the casino mentality that drove many new technology companies to unjustifiable heights that same year. Great patience is a necessary ingredient in investing, and that patience can be sorely tested. Operational changes at a company might take longer than expected to have an impact. A weak economy might create unexpected challenges to even the best corporate strategies. General market malaise, volatility, or discordant news can vex an investor. While shares in a high-quality growing business purchased at a reasonable price should perform well over time, that doesn't mean they will perform well all of the time. Investment success is usually not linear. It comes in bursts and is often followed by setbacks. Investors should focus on the destination while bracing themselves for the journey. Even the most successful long-term investments have prolonged periods of underperformance. Case study: Microsoft. I find that tracking exceptional businesses over time, those that have compounded investor capital at robust rates for a number of years, helps in identifying attractive entry points for investors. Let's consider Microsoft as a case study. While its fastest growth might have been behind it by 2010, I believed this great business franchise would deliver reasonable growth. The market had legitimate fears about recent developments, like the transition from desktop PCs to tablets, real operating system competition for Windows from Apple's iOS, and the potential for Google Chrome to take word processing market share from Office. Moreover, the Microsoft management team had not been covering itself in glory. While the stock market was pricing the company as one whose prospects had dimmed, we felt that Microsoft was underappreciated. For example, Salesforce.com, a leading cloud player with $2 billion in revenues, was valued at more than 100 times forward earnings. Microsoft was also a leading cloud player as measured by number of users and revenue, yet the market awarded it just 1/12 the PE of Salesforce. To bolster its place in the cloud, in 2010, Microsoft said it would spend 90% of the company's annual $9.6 billion R&D budget on its cloud strategy, a sum more than 4 times Salesforce.com total revenues. With Microsoft's R&D staff of 40,000 and a portfolio of product offerings that touches almost every organization in one way or another, we were confident the company would remain relevant in the burgeoning world of corporate cloud computing. While Microsoft's earnings grew at an annualized rate of 17.4% from 1999 to 2009, its stock price declined at an annualized 5.3%. Applying the principles of Graham and Dodd, we determined that Microsoft's intrinsic value was well in excess of its market value, and moreover, it had good growth prospects. We bought the stock in 2010 at 12 times trailing earnings net of cash, 13.4 times reported, a 20% discount to the S&P 500 that traded at a PE of around 15 times at that time. From 2010 to 2020, the company's earnings per share grew at a 10.8% annual rate, aided by repurchasing almost 13% of its shares. Its price-earnings multiple expanded to 38.3 times trailing earnings, which drove a 25.9% annualized total return over the decade, inclusive of dividends. Was Microsoft a growth stock or a value stock? It was both. While the company delivered sound earnings growth, the price at which we were able to acquire the shares made it a good value. Purchasing shares in a durable, good-quality business that is growing faster than the market but trades at a discount should be a recipe for making money over time. Finding opportunities with asymmetric risk-reward ratios and better than a 50-50 likelihood of a favorable outcome should improve one's slugging percentage. We believed that was the case with Microsoft, where we felt the odds of success had been miscalculated. The downside would have been limited even if earnings had fallen below our estimates, providing a margin of safety, while the potential for upside was sizable. We also believed the prospects for corporate success improved further once new leadership was put in place in 2014. Nonetheless, there will always be mistakes while abiding by this process. There's an old Yiddish adage, man trakt und Gott lacht. Man plans and God laughs. New competitors emerge and disrupt. Venerable competitors raise their game. Management makes mistakes. The macroeconomic environment unleashes a surprise. Since the world is in a constant state of flux, it is imperative to regularly revisit an investment thesis and actively seek reconfirmation. I have made my share of mistakes. Investments in Circuit City, Semitech Global, and Conseco were all sold at a loss. I failed to properly weigh such crucial elements as changing competition, weak management, and poor underwriting. Being good at investing doesn't mean batting 1,000. Even Major League Baseball's All-Stars get on base only 30% of the time. One of my former partners, Bob Rodriguez, managed the FPA Capital Fund and delivered the best performance of any diversified mutual fund over the quarter century between 1984 and 2010. Yet he also had 2 positions that went to zero. Accepting that you will make some big mistakes is part of investing. Since we believe investors cannot successfully time the market, we believe cash should be the residual component of the investment process. When there are no compelling opportunities at hand, we choose to wait. Sitting on your hands can be difficult when you see the portfolios of others increase in value, but we believe this is better than owning positions you don't find attractive. In their fiscal year 2000 annual letter to shareholders, Leucadia National Corporation's former chairman, Ian Cumming, and former president, Joseph Steinberg, spoke to this dynamic, likening themselves to groundhogs. We pop out of our holes each and every morning and look around the marketplace for investment opportunities. The first question we ask is, do we see anything that can earn more than the risk-free rate adjusted for risk? When the markets are as high as they have been in the last many years, we saw very little of interest and went back down our holes. Patience is required for this process, but it is not complicated. Unfortunately, most investors prefer to see stock prices appreciating before they invest, and they usually sell when they get scared, which is often after experiencing a measurable decline in the value of their portfolio. As a result, the average investor underperforms stock indexes and their own goals, missing many large market moves to the upside while still participating in the downside. If you can ultimately match the return of the market while truncating the worst periods of market downside, you're delivering considerable value to your clients. A broad, unfettered mandate has allowed us to accomplish this, using a diverse toolkit to invest in a broad range of markets and instruments. We have allocated capital across a company's capital structure. We have put money into public and private credit, as well as in a variety of market capitalizations, industries, geographies, and asset classes. We have even had short positions from time to time. I believe it is foolish to give a money manager an overly narrow mandate. The marketing conversations may be easier, but the investment outcomes are likely to be poorer. I'm confident our clients benefit from our broad mandate. Consider the real estate market. The decision to buy a 10-story, 30-story, or 70-story office building is analogous to buying a small, medium, or large cap company. The factors are the same in determining the value of these commercial buildings and include examining comparable in-market sales, capitalization rates, replacement costs, and local occupancy levels. A value investor should invest in the building that has the best relationship of price to value regardless of size. If none of the buildings offer a favorable opportunity, then an investment should not be made. But what if the 70-story building wasn't priced at a level where you would want to own it, or you can't buy it because it isn't available for sale? What if its first mortgage can be purchased at such a discount that if the building owner were to default, you could foreclose and take control of the building at a price that would make it very hard to lose money? That's what happened to Rockefeller Center in 1995 when Mitsubishi Estate Company, its former majority owner, filed for bankruptcy protection. The debt of Rockefeller Center Properties, Inc., the real estate investment trust that held its mortgage, traded at a discount to par, allowing for a double-digit rate of return in a worst-case scenario. In the event of a foreclosure, we had good downside protection. We would have taken control of Rockefeller Center at a discount to replacement cost. Recognizing opportunity. While investors need to be open to opportunities, they also need to be aware of limitations. As we've noted, we seek opportunity across a broad range of countries, markets, securities, and strategies. But simply because we can invest with such breadth does not mean we always should. Instead, we only invest where we believe there is an excellent prospect for return combined with a margin of safety. This applies to a number of asset classes. Equity. When we make an equity investment in a business, we go beyond balance sheet analyses and the search for a margin of safety to seek out growing businesses with defensible niches, good returns on capital, and reasonable valuations. Such businesses should also be involved in expanding industries in countries where the rule of law is strongly enforced. We shy away from those businesses and industries where the potential range of outcomes is particularly wide and avoid entirely those where our skill set limits our ability to either evaluate the business or handicap the likelihood of a particular outcome. Over the years, we have found our better investments have been those with more than one way to win and with substantial upside potential, so that a lot of money can be made if things turn out favorably. CVS Health, one of the nation's two largest pharmacy retailers, had many of the characteristics we like to see, including inexpensive multiples of cash flow and earnings, industry growth, and good management. Besides its ubiquitous drugstores, it owned Caremark, a pharmacy benefit management (PBM) business. To assess the value of its shares, we separated the business into its two primary parts. In 2010, the company as a whole traded at about 11.5 times estimated one-year forward earnings. However, if we applied the same valuations to CVS's PBM that were applied to its peers, then the valuation of the remaining business, primarily CVS Pharmacy and Retail, was just 9.4 times one-year forward earnings. That is, it was inexpensive and there was a margin of safety. The pharmacy segment was well positioned to benefit from several industry macro trends, including an aging U.S. population that would be needing more prescription medicines, federal health care reform that would dramatically increase the number of insured and therefore the number of prescription buyers, and improved profit margins from the continuing shift to generic drugs. CVS's private brands represented 17% of total sales. By contrast, Kroger, which operated grocery stores that included drugstores, had 28% private brand penetration. That, in turn, paled next to UK-based Tesco's 50%. This left CVS with a lot of runway for margin expansion. We expected the retail segment to continue to benefit from a greater volume of private label products that would offer a roughly 10 percentage point increase in gross margin. Meanwhile, CVS had historic growth through acquisitions, and its management was beginning to focus its attention on the substantial potential for operational improvements. At one point, the retail and pharmacy division operated with 7 inventory management systems, while Caremark had 5 different claims platforms. By 2013, their goal was to be down to 1 platform each, which should allow them to reduce retail store inventories by $2 billion, representing about $1.50 per CVS share, or 4.2% of the share price at that time. Moreover, we believed that CVS's Caremark PBM could improve its contribution to CVS EPS and potentially add an additional $3 to $4 per share in value over 3 years. We also liked that CVS's skilled management acted with the mentality of an owner-operator. They had substantial financial stakes in the company, which was likely to ensure they pursued what was in the best interest of shareholders. We believed CVS's pharmacy and retail business had a larger moat than its PBM segment and offered a clear roadmap for sales growth and operational improvement. Given that there were publicly traded PBM peers like Medco Containment and Express Scripts, we believed we gained exposure to a business at a lower valuation by shorting these more highly valued companies in rough proportion to our conservative view of the intrinsic value of CVS's own PBM. In short, we felt whatever risks CVS faced were outweighed by a low valuation that provided both a likelihood of investment success and a margin of safety. However, successful investing requires not only getting in at a good time, but exiting at a good time as well. We accumulated our CVS position in 2010, and about 5 years later, we concluded that we had received the full benefits of management's solid execution of its business plan, as well as the favorable macro trends we had expected. Going forward, we also felt the changing competitive landscape meant CVS would face more online retailers offering more convenience, often at better prices, and that would put pressure on the sales of its general merchandise in the front of the store. With the price no longer compelling, we decided to sell our position in CVS in 2015. By then, CVS's earnings growth and PE multiple expansion translated into a stock price that tripled from 2010 to 2015. Meanwhile, we achieved a roughly break-even result on the short sales. Credit. Similar principles have informed our investing in fixed income. There are 3 types of credit instruments in which we generally traffic: performing bonds, distressed debt, and private credits. In buying a performing bond, we strive to ensure not only that we will be repaid on a timely basis, but also that we can obtain a yield to maturity that is equity-like, generally 9% to 11%. Given the greater risks associated with distressed credits, we have generally set the target yield at a mid-teens or higher yield to maturity. Our experience is that private credit markets can be particularly inefficient, thereby offering excess returns for the risk involved. The financial markets can be an emotional pendulum that swings from exuberance to fear. Financial stocks were greatly overvalued in the euphoric conditions that preceded 2008's great financial crisis, for example, and then they swung too far in the other direction. But that mispricing created opportunities in the corporate debt of financials and distressed mortgages. We knew that subprime mortgages were particularly hated, so we investigated whether investor fears might be overblown. By the end of 2009, the housing market had declined approximately 29.5% in the largest 20 metro markets. We identified a basket of distressed mortgages, Alt A, that we purchased at a 66% discount to the original appraised home value and a 37% discount to the 2009 year-end depressed home value. We concluded that the underlying group of homes would have to decline an additional 30% before we would be at risk of losing money. With this margin of safety, we were likely to earn an attractive fixed income return on our position with a minimal potential for loss. At our purchase price, we effectively owned the homes underlying these mortgages at an average value of approximately $99,000 per home. This home value provided us an additional margin of safety because these homes were competitive with apartment rentals at this price. By mid-year 2010, we saw that the performance of this mortgage pool, including interest, had returned more than 30% of our initial capital investment. Looking just at the properties unwound, they generated a total return on our investment of more than 24%. In addition, we earned a better than 8% current yield on our remaining basis in the portfolio. Since the early returns validated our initial thesis, we continued to buy additional pools, aggregating thousands of mostly non-performing mortgages. While the early results were better than we would have expected, it was too soon to declare victory. The difficult tail end of the portfolio, deferred maintenance, property damage, and litigious situations remained. Fortunately, the tail played out within the range of expectations, and the weighted average return of these distressed mortgages turned out to be 12.5%. Charlie Munger once explained, "Part of the reason we have a decent record is we pick things that are easy. Other people think they're so smart that they can take on things that are really difficult. That proves to be more dangerous. You have to be shrewd, and you have to be patient." He added, "For an ordinary person, can you imagine just sitting there for 5 years doing nothing? It's so contrary to human nature. You don't feel active, you don't feel useful, so you do something stupid." A big part of investing is indeed waiting patiently for a fat pitch right over home plate and then swinging aggressively. Due diligence process. As value investors, we focus on what is out of favor or misunderstood. We begin our process of determining which asset classes, industries, or regions might offer the best opportunities to reach our established longer-range goal of equity-like returns with less than market risk and allocate our time accordingly. We spend a lot of time asking a lot of questions about both the problems and prospects of a potential investment. What are the forces that will shape its fate? What's the downside? What if? We regularly seek a contrary view to avoid the positive reinforcement of an echo chamber, and we invert our thesis to see the investment from a different lens, where things may not look as rosy. These efforts have helped us identify areas of opportunity, like in early 2009 when distressed debt was priced for a depression scenario, while avoiding others like financials for much of the early to mid-2000s, when prices failed to reflect the risk of subprime debt proliferation and the interrelated housing bubble. We speak to relatively few investment professionals outside our firm. We prefer to spend less time on Wall Street and more time with people on Main Street, customers, competitors, company executives, and industry experts, because we believe this interaction improves our understanding of businesses and industries. We read a lot, everything from SEC filings and conference call transcripts to pertinent periodicals and industry studies. We work to gain a knowledge edge, a level of understanding of a business or industry that may not be universal. Of course, some companies are followed so extensively that we can't differentiate ourselves in this fashion. When analyzing businesses, sometimes financial statements tell the story. In those cases, we favor investments that typically appear cheap based on reported financial results. But in other situations, information not in the financial statements might be most relevant, such as data regarding a company's position on the industry cost curve, characteristics of its total addressable market, its customer acquisition costs and lifetime value, and real assets marked to market. In these situations, our holding might appear expensive based on reported financial results, but when you look deeper into these other factors, you can discern why we think such companies are undervalued. Since we operate with imperfect knowledge, we prefer to establish a potential range of outcomes. We build financial models that look out a few years with low base and high cases. A good investment is one where an acceptable return can be had in the base case and where the high case scenario should be more likely than that of the low case. As we seek to find a good business and understand it, one thing we pay close attention to is its free cash flow, rather than net income, a metric that does not, among other things, take into account capital spending and working capital. In our view, all sensible fundamental investing is value investing, by which we mean buying a business or asset for less than what it is worth under reasonable scenarios. Buying growing businesses with an adequate margin of safety is just as much value investing as buying, for example, a financial firm at a discount to tangible book value or a holding company at a discount to readily ascertainable net asset value. Conversely, while growth stock investing is often characterized by high valuations, that doesn't mean the prices are unwarranted. A company trading at 50 times earnings that grows 30% annually over the next 5 years could still deliver a 17.4% return, even if its PE falls to 30 times at the end of that span. However, there is a perishability to such high valuations on the front end. If that company grows at a respectable 15%, but its PE shrinks to 20 times, then the stock price would be lower by almost 20%, a negative 4.3% IRR in those 5 years. And that's only if you were right about the earnings over that 5-year period. Psychology, risk. Thoroughly understanding a business and the competitive landscape of its industry is necessary but not sufficient. This process is significantly enhanced by an ability to work through corporate financial statements, including the footnotes. There's another crucial skill in successful investing, understanding investor psychology, both your own and that of others. Are you likely to act without a good thesis and proper due diligence just because you heard a good story? Or are you more apt to not act at all because you are fearful of losing money? Can you recognize a mistake and sell a stock, or are you more likely to hold on, hoping for a higher price, believing you haven't really experienced a loss until you actually sell the holding? In the last few decades, the study of investor psychology, called behavioral finance, has taken on a growing role in the field. While we will not rid ourselves of emotions, which make us human, we should recognize the psychological factors, the fear and greed, the inertia, as well as hyperactive trading that can weigh on investors. These are necessarily bound up with the due diligence and rational decision-making that shape investment decisions. Investors need to recognize their own behavioral settings and biases and compensate for them as warranted. Attitudes toward risk are always at the core of investing. We cannot eliminate risk, but we can seek to identify it, understand it, minimize it, and be adequately compensated for it. We recognize that mispriced risk can create a buying opportunity. The risks we consider in our investing include credit, currency, business obsolescence, fraud, sovereign, interest rate, inflation, litigation, expropriation, customer concentration, vendor disruption, competition, economic, balance sheet, and political. We believe the ultimate investment risk is a permanent loss of capital. Some confuse risk and volatility, but what happens as a result of short-term market volatility should be entirely irrelevant. If your portfolio is traded at $1,000 today and it drops to $750 next year, but you ultimately sell it for $2,000 5 years from now, you've compounded your capital at almost 15%. If, on the other hand, the 25% drop to $750 leads you to sell, then you've unfortunately let price, rather than value, be your guide. In this case, volatility has become your enemy. If you have good reason to trust your investment thesis, better to make volatility your friend and buy more at $750 and thereby achieve a 28% return on your incremental investment for the next 4 years. While the stock market functions as a voting machine from day to day, it's effectively a weighing machine over the long term, as Graham and Dodd famously observed. Just as a thermometer gives you a temperature reading today but says nothing about tomorrow, a stock price or its movement over shorter time frames say nothing about how much that business might be worth in the future. Like Graham and Dodd before us, the irrational behavior of others has allowed us to both buy at a discount and sell at a premium. Foolish investing behavior exists broadly. Investors in mutual funds, for example, have a tendency to deify those managers after a great run, the worst possible time. Morningstar developed an illuminating report that held up one particular mutual fund as an unambiguous example of this behavior. Assets flowing into a certain fund peaked in 2007, following an 80% commodity-fueled return that year, just in time for the fund to shed half its value in 2008. Not only have most investors not pocketed any of the fund's 18% gain during the past decade, but the typical investor in the fund has lost nearly 14% per year, a stunning 32 percentage point investor return, total return gap. This fund had LIFO investors, last in, first out, and they came and went at precisely the wrong times. Just as it's easy to be too active, it's also easy to allow complacency to lead you to do the same things tomorrow that you did yesterday. That's true with investment processes as well as with the choice of individual investments. Inertia could have kept me in my balance sheet-centric value investing box, but I recognized the need to change. I recognized that the world of business was changing around me at a more accelerated rate than at any point in history, and if I didn't change with it, then I would likely suffer long-term underperformance and irrelevancy. This is particularly true with regard to technological change. While there are a host of social, political, and economic forces buffeting markets, Day-by-day technological innovation continues to impair the economics of many businesses and render others obsolete. The recent accelerated pace of technological innovation has created a multitude of new businesses, while long-established businesses are eroding at an accelerating rate. I could have appreciated more quickly that historic technological advances were adversely impacting the businesses of our more traditional value investments. I was more entrenched philosophically than one of my partners who exhibited greater flexibility and helped move our portfolio, to the benefit of our investors, further in the direction of reasonably priced, higher quality, growing companies characterized by unquestionable competitive strength, solid balance sheets, and shareholder-centric management. An important component of investing includes surrounding yourself with smart people, considering diverse points of view, and being willing to admit when you are wrong. While businesses face the daily choice of how fast to reinvent themselves, the same can be said of investors, who must not only psychologically condition themselves to question the status quo, including their own, but to gird for the surprises that will inevitably occur that will impact positions in their portfolio. As the Roman philosopher Pliny the Elder noted 2,000 years ago, the only certainty is that nothing is certain. Or, as has been attributed to that modern-day philosopher Mike Tyson, everyone has a plan till they get punched in the mouth. Knowing there will be surprises takes some of the emotional sting out of them when they occur, allowing for a more clinical approach to investing. It keeps us from getting scared out of investments as much as it keeps us from getting scared into them. Knowing in advance that we will periodically be out of favor helps us act rationally when we are. You can't control broad investor behavior, but you can control your own. Conclusion. At the end of the day, I am a value investor because it makes sense to me and fits my risk-averse personality. While much has changed since Graham and Dodd wrote their masterwork, investing in companies at a price that offers a margin of safety continues to serve investors well. I believe that value investing is, for me, the best means to preserve capital and generate attractive returns over the long term. The most relevant financial variables and indicators may change, but the principles remain sound. Investing with Owner-Operators, The Importance of Alignment, by Benjamin Stein and Zachary Sternberg. The two of us have been very fortunate beneficiaries of the tradition of intellectual generosity and mentorship among value investors, a tradition whose roots date back to Benjamin Graham and David Dodd's publication of Security Analysis. In the summer of 2004, as a 17-year-old on the beach, one of us worked through the 1940 edition, underlining the following two sections of this timeless classic. We must recognize, however, that intrinsic value is an elusive concept. The essential point is that security analysis does not seek to determine exactly what is the intrinsic value of a given security. It needs only to establish either that the value is adequate to protect a bond or to justify a stock purchase, or else that the value is considerably higher or considerably lower than the market price. It will be evident from the chart that the influence of what we call analytical factors over the market price is both partial and indirect. Partial because it frequently competes with purely speculative factors which influence the price in the opposite direction, and indirect because it acts through the intermediary of people's sentiments and decisions. In other words, the market is not a weighing machine on which the value of each issue is recorded by an exact and impersonal mechanism in accordance with its specific qualities. Rather, should we say that the market is a voting machine, whereon countless individuals register choices which are the product partly of reason and partly emotion. Survey and Approach, pages 20 to 22 and 27, 1940 edition. Reading these lines today, they ring as true as ever. They clearly lay out the goal of the security analyst and offer a framework for applying its simplest message. Buy companies for less than they are worth, and understand that doing so is an art and not a science. The chart previously referenced sets out the elements that Graham and Dodd considered intrinsic value factors. These include earnings, dividends, assets, capital structure, terms of the issue, and others. And then there are future value factors, including management and reputation, competitive conditions and prospects, and possible and probable changes in volume, price, and costs. Future value factors straddle the labels speculation and investment. But since the value of every asset is the present value of its future cash flows, we focus our efforts on the quantitative and qualitative inputs that in our judgment will affect future cash flows. It was the Berkshire Hathaway annual shareholder letters written by Graham's best-known student, Warren Buffett, that initially inspired us to go down the value investing path. The basic premise of owning equity in businesses that can grow and increase in value for long periods of time made sense to us immediately. When you invest in a business that is growing, time is your friend. For a stagnant business, it decidedly is not. The idea of long-term business partnership with great managers, such as Warren Buffett has done with Berkshire Hathaway, resonated most with us and felt in sync with our personalities. Betting on the movement of share prices, by contrast, felt short-term oriented and unnecessarily transactional. The two of us met in 2004 during our freshman year at the University of Pennsylvania, and we became friends living in the Spruce House dormitory. At age 20, we ran the math and realized that $1 compounded in value at 20% per year would turn into $9,100 by the time we were 70. Even at 15%, each dollar would be worth $1,084. We quickly came to the conclusion that we should get started immediately. Time really was our friend, and so long as we remained disciplined and focused, we would have a chance to begin to achieve our goals. We realized that each day was a fresh opportunity to study a publicly owned business and perhaps reach the conclusion that its shares were worth owning. We knew that we could pull up the annual letters and financial statements of any company in a matter of seconds. It was an exciting idea then, and still is today, that almost every day we could decide to own a small piece of almost any business in any industry in any part of the world. So we put some of our own capital together, opened an E-Trade account, and a year later went around hat in hand to try and gather support from friends and family. We loved investing from our dorm rooms and love it even more years later. Our original mindset and culture remain part of our value system today. Spruce House is not a hedge fund, but a friends and family investment partnership, with only a handful of large institutional partners and a concentrated portfolio composed of holdings in a group of public and private companies run exclusively by founders. We have no investor relations function or capital raising effort, and we hope to have the same group of partners around the table for decades to come. From the beginning, the idea was to have only a few reliable and long-term oriented partners for whom we could have a material beneficial impact over a very long period of time. Today, 17 years after we started investing together, we continue to manage the capital entrusted to us as if the two of us would be lifelong partners and the capital were all our own. This is because our sole mission has always been to create an environment that allows us to compound our capital at the highest rate possible, not to build an asset management business. Over the years, we have invested in many different types of businesses, and while we have always had a sharp pencil on price, our most successful investments have all been the result of being right on two essential factors: figuring out which businesses we wanted our net worths invested in, and even more important, whom we wanted our net worths invested alongside. We call this having the right cards in the right hands. In Berkshire Hathaway's 1987 annual report, Warren Buffett pointed out, "The lack of skill that many CEOs have at capital allocation is no small matter. After 10 years on the job, a CEO whose company annually retains earnings equal to 10% of net worth will have been responsible for the deployment of more than 60% of all the capital at work in the business." This simple truth has major consequences for a long-term owner of equity. Over time, the returns on capital of the entire business will converge with the returns from these additional capital commitments. Either management thinks rationally about reinvesting capital at satisfactory returns across their four options: to reinvest in the business, acquire other businesses, repurchase shares, or pay dividends, or they don't. Graham was skeptical on this subject. In the section on the theory of common stock investment entitled "The Merits of Plowing Back Earnings," Graham points out the weakness in the assumptions many make regarding management's retaining earnings. Whatever benefits a business benefits its owners, provided the benefit is not conferred upon the corporation at the expense of the shareholders. That exception is no small matter. Alignment of interests is essential in investing capital, whether in markets or in businesses. If you are going to own interests in companies for the long term, you effectively own the sum of all the decisions made in the organization each day. So understanding managements and how they think seemed very important to us. We developed the view that founders who live and breathe their businesses 24/7 make the best business partners. They are able to clearly articulate a true north goal within their organizations, which increases the likelihood that business decisions are made with that goal in mind. By contrast, a CEO hired to run a company may have multiple objectives as well as a shorter-term orientation. A long-term oriented and focused founder is more likely to be an excellent allocator of capital than committees of board members who do not own much stock in the company. We jokingly call these asterisk boards because the proxy statement lists director ownership of less than 1% as an asterisk. One question we always ask public company founders is which decisions they would make differently if they owned 100% of the equity themselves and the company were private. Ideally, they say there are few, if any, differences from what they are already doing. It is crucial that they avoid the short-term orientation that afflicts so many CEOs and boards of publicly traded companies. These founders know that the truth about a company's value resides not in its ephemeral share price, but in its prospects for longer-term cash flow generation. For example, several years ago, Spruce House was one of the largest shareholders of XPO Logistics, one of the largest logistics companies in the United States, run by Brad Jacobs. In December 2018, Jacobs, a meticulous acquirer of businesses, was about to close the largest acquisition in XPO's history. However, XPO's share price dropped 42% in a matter of days, and instead of chasing the deal, Jacobs pivoted virtually overnight and repurchased $1 billion of XPO shares instead, ultimately buying back 24% of the company. As Jacobs explained to us at the time, he looks at each decision through the lens of return on capital and return on time, and both pointed to a large share repurchase instead of the acquisition. He could not beat the return on time achieved by calling his broker and owning a lot more of a business he already knew intimately at a discounted price. This compared very favorably to the effort involved in negotiating, financing, and integrating an acquisition he inherently knew less about than his own business. We find this type of clarity and agility to be rare, and it certainly does not reside in the collective consciousness of most boards. It is not a coincidence that since Jacobs took control of XPO in September of 2011, the compound annual return through year-end 2021 was 36%. The main qualities we are looking for in founders are rational thinking and intellectual honesty. We get particularly interested when clarity of mind is accompanied by leadership and operating skills and a clear framework for allocating capital to build business value as measured by cash flow per share. During our summers at Penn, we worked for the noted value investor Bob Robotti, who would come to be both a mentor and a friend. We are eternally grateful and indebted to Bob. He gave us an office, spent as much time teaching us as we could absorb, and always set an example of extraordinary integrity. We also had so much fun traveling around the world with him visiting companies. Bob has hosted many investment partnerships in his office over the years. Each of them had a slightly different strategy, but all were heavily influenced by the intellectual roots laid down in security analysis. Naturally, we studied many of the companies that Bob had owned for years. He knew virtually limitless details on how these businesses worked and the economics of the ecosystems in which they operated, which gave him a nuanced understanding of how the competitive dynamics of an industry were likely to evolve and affect future returns. Robati's approach led us to study and invest in many different types of businesses early on. Like so many influenced by Graham and Dodd, we began by focusing on buying companies with balance sheets trading at a discount, with downside protection supported by hard asset value. We owned shares in companies operating in offshore oil drilling, oil and gas services, insurance and shipping, as well as housing distribution businesses coming out of the other side of the 2008 financial crisis post their restructuring. These businesses often relied on large amounts of financing, had cyclical end markets, and had customers with substantial bargaining power. While we could mathematically assess the limited downside, the reality was that realizing a return over a long-term holding period would be based largely on management's reinvestment decisions. In some cases, the reinvestment opportunities for such companies were primarily in capital-intensive, cyclical assets, which could be a daunting prospect. Although we experienced some success in such businesses, this tended to be a result of us buying into and then selling them well. We did not think we could count on that continuing into the future. We felt more comfortable trying to identify businesses we might be able to own for a decade or more with excellent owner-operator CEOs at the helm. One example dates back to 2011 when we began buying shares in First Service Corporation, which had a market capitalization of just over $1 billion and owned several businesses, including the commercial real estate services brokerage Colliers International, First Service Residential, the largest manager of housing units in the United States, and several well-known housing-related franchise businesses such as California Closets. But most important, First Service Corporation had Jay Hinnick, who had compounded the share price since the company went public in 1995 at 20% per year. Hinnick is a natural entrepreneur. His first job as a lifeguard in high school sparked the idea of starting a pool cleaning business, which opened his mind to the opportunities available in selling a broad array of real estate services. Hinnick has taken the approach of creating value one step at a time. By 2015, First Service and Colliers had become separate public companies with a combined market capitalization of over $10 billion. And Colliers has since developed a real estate fund management business with $88 billion of assets under management, another real estate services business which did not exist when we purchased our first shares. Good things happen when you invest with good people with the right priorities. The opposite is also true. Unfortunately, we have learned this lesson the hard way. We are attracted to investments in which we have both a margin of safety and multiple ways to win. Jay Hinnick's disciplined deployment of capital into attractively priced acquisitions with contractual terms structured to protect the downside has led to extensive low-risk growth. The company had one built-in opportunity to expand as the best and only liquid buyer of Colliers' local market affiliates. This allowed us to project the future by evaluating the company's current operations and past success acquiring franchisees. From time to time, we were able to purchase Colliers shares at significant discounts to our conservative estimate of the future cash flows of its various businesses and even at multiples of our original cost because of the growth runway that continually seemed to grow longer as Hinnick figured out the next strategic move. Today, one of us serves on the Colliers board of directors, and we are as excited about the future of Colliers today as we were 10 years ago. A number of the companies we have invested in follow an organic growth plus acquisitions model. They may not be in the most exciting industries, but are leaders in areas such as real estate services, flooring, insulation, and logistics. Each enjoys large end markets, provides a basic and necessary product or service, experiences high levels of industry fragmentation, and can capture economies of scale. However, without an owner-operator on a mission to compound capital at high rates, these would not be particularly exciting investments. We think it is important to recognize that the founders did not fall into these businesses, but rather hand-picked these industries for their specific attributes, which would enable large-scale wealth creation through consolidation and continually improving their customer value proposition relative to competitors. As we spent more and more time with founders, CEOs, and continued to calibrate how we wanted our net worths invested, we started thinking harder about the future and handicapping what it could look like. For example, we have been long-term shareholders in Wayfair and Carvana, which we see as logistics networks that are very difficult to build and which enable a consumer offering that is hard to compete with and improves, for both the consumer and for shareholders, with scale. Both of these founder-run businesses are investing heavily in providing consumers the largest selection and fastest delivery of two very basic products, home goods and used cars, which simply cannot be replicated by competitors outsourcing key functions to third parties. We learned to disaggregate and recreate income statements in order to unmask quantifiable growth investments. The goal was to understand underlying unit economics and figure out at what price and what growth rates we would be willing to purchase shares, while also understanding the sources of downside protection in the long term. Because the growth prospects had not yet turned into current cash flows, Ben Graham would call this speculation. We were, and still are, willing to bet that the winner takes most dynamics of shifts in the economy, such as those from large, fragmented offline markets to online markets, will provide more than a commensurate return. This is particularly true for businesses that have a proven ability to operate profitably and are clearly choosing to reinvest current cash flows to meet customer demand. In many ways, parts of our approach continue to evolve to reflect our own interpretation of Graham, such as when he writes that investment is most intelligent when it is most businesslike. Over the years, some of the people we look up to most have told us being a business person has made them a better investor, and being an investor has made them a better business person. We have really taken that to heart and tried to apply it to Graham's observation. In recent years, a number of wild cards have made investing more challenging, namely the COVID-19 pandemic and the government's monetary and fiscal response, the war in Ukraine, and then the ensuing inflation and central bank tightening. It has become more difficult for CEOs to forecast and operate their businesses amid such conditions, and we are keenly aware that other unknown challenges certainly lie ahead. As we write, in 2022, many of the businesses we own and follow are available at what appeared to be deep bargain levels, while management teams adjust operating expenses in the light of shortfalls in forecasted revenues. Meanwhile, short interest has often risen to extraordinary levels across many of these companies, temporarily depressing share prices further. While we have great humility when short sellers take a position in one of our investments and always challenge ourselves to understand where we could be wrong, it is also important to remember Graham and Dodd's sage observation that market prices are there to serve you, not to inform you. Graham started his partnership when he was 31 years old, and 3 years later he managed it through the crash of 1929, followed by the Great Depression and then World War II. It's difficult to imagine how much of a challenge it was investing in those times. In the preface to the first edition of Security Analysis in May of 1934, Graham and Dodd wrote, "While we were writing, we had to combat a widespread conviction that financial debacle was to be the permanent order. When headlines and casual business conversations cannot help but turn to fear of the macroeconomic environment, we are reminded of Warren Buffett's comment in Berkshire Hathaway's 1994 annual report. We will continue to ignore political and economic forecasts, which are an expensive distraction for many investors and businessmen. 30 years ago, no one could have foreseen the huge expansion of the Vietnam War, wage and price controls, 2 oil shocks, the resignation of a president, the dissolution of the Soviet Union, a one-day drop in the Dow of 508 points, 22.6%, or Treasury bill yields fluctuating between 2.8% and 17.4%. But surprise, none of these blockbuster events made the slightest dent in Ben Graham's investment principles, nor did they render unsound the negotiated purchases of fine businesses at sensible prices. Imagine the cost to us, then, if we had let a fear of unknowns cause us to defer or alter the deployment of capital. Indeed, we have usually made our best purchases when apprehensions about some macro event were at a peak. Fear is the foe of the faddist, but the friend of the fundamentalist. We would note, however, that these macro shocks can be particularly painful for higher growth businesses because a steep and sudden reduction in demand can have larger implications for their balance sheets than just a few years earlier. All of their revenue and expense line items have so many more dollars running through them than when the firms were smaller. As a result, we have been encouraging faster-growing companies to build in an extra margin of safety in their balance sheets, especially at times when capital is readily available to them and there seems to be no immediate need for it. While we are acutely aware of the cost of dilution from maintaining a stronger balance sheet, we believe managements should always prioritize investing in technology, systems, and talent. Failure to do so can erode a company's competitive advantage and, if funded with debt, can limit the company's future flexibility to invest in new, potentially high-returning ideas. In high-growth businesses which are likely to produce growing sums of free cash flow in the not-too-distant future, ensuring the operating financial strength and depth of talent must be paramount. Maintaining all of the flexibility that comes with being in a position of strength has allowed several of the businesses we own to make acquisitions, repurchase shares at very attractive prices, and continue to build up future earnings power through difficult economic periods. It's powerful if you can work on the numerator and the denominator at the same time. Investing is hard and often humbling. We are regularly reminded that we must remain intellectually open, constantly learning, and focused on calibrating a multitude of potential opportunities to ensure that each dollar entrusted to us is hard at work. As we have slowly grown our client base over time, we think about how any new partner might behave in difficult times. We seek only those partners who truly have a multi-decade view. If you own a very concentrated portfolio of companies as we do, and don't short or hedge, you're guaranteed to have significant volatility in your returns. There's no way around it. Warren Buffett has famously written about having his net worth cut in half 3 times in his life. Ben Graham reportedly nearly went broke twice. As we write, in the fall of 2022, we are going through one of these very painful drawdowns. A truly long-term view is the only way we know of to look past near-term business performance and short-term share price volatility and to make actionable estimates of value 5 years from now. Investing with a deep fundamental understanding of each business, a tightly aligned group of partners, and not using leverage are the key ingredients needed to get through these periods. It's crucial to remember that no business grows in a straight line. What might look like obvious rewards from owning successful businesses today were nonetheless tested more than once with periods of anxiety, uncertainty, and stress along the way. The investors we admire most have an even temperament that means not getting too excited in the good times or too downtrodden and emotional in the tough times. They have the patience and discipline to swing only at pitches they are comfortable with. They have done the work to ride out often unpopular views, and perhaps most important, they all possess a deep sense of optimism that each day the next great investment is out there waiting to be discovered. Chapter 31. Analysis of the Income Account. In our historical discussion of the theory of investment in common stocks, we traced the transfer of emphasis from the net worth of an enterprise to its capitalized earning power. Although there are sound and compelling reasons behind this development, it is nonetheless one that has removed much of the firm ground that formerly lay, or seemed to lie, beneath investment analysis and has subjected it to a multiplicity of added hazards. When an investor was able to take very much the same attitude in valuing shares of stock as in valuing his own business, he was dealing with concepts familiar to his individual experience and matured judgment. Given sufficient information, he was not likely to go far astray, except perhaps in his estimate of future earning power. The interrelations of balance sheet and income statement gave him a double check on intrinsic values, which corresponded to the formulas of banks or credit agencies in appraising the eligibility of the enterprise for credit. Disadvantages of sole emphasis on earning power. Now that common stock values have come to depend exclusively upon the earnings exhibit, a gulf has been created between the concepts of private business and the guiding rules of investment. When the businessman lays down his own statement and picks up the report of a large corporation, he apparently enters a new and entirely different world of values. For certainly he does not appraise his own business solely on the basis of its recent operating results without reference to its financial resources. When, in his capacity as investor or speculator, the businessman elects to pay no attention whatever to corporate balance sheets, he is placing himself at a serious disadvantage in several different respects. In the first place, he is embracing a new set of ideas that are alien to his everyday business experience. In the second place, instead of the twofold test of value afforded by both earnings and assets, he is relying upon a single and therefore less dependable criterion. In the third place, these earnings statements on which he relies exclusively are subject to more rapid and radical changes than those which occur in balance sheets. Hence, an exaggerated degree of instability is introduced into his concept of stock values. In the fourth place, the earnings statements are far more subject to misleading presentation and mistaken inferences than is the typical balance sheet when scrutinized by an investor of experience. Warning against sole reliance upon earnings exhibit. In approaching the analysis of earnings statements, we must, therefore, utter an emphatic warning against exclusive preoccupation with this factor in dealing with investment values. With due recognition of the greatly restricted importance of the asset picture, it must nevertheless be asserted that a company's resources still have some significance and require some attention. This is particularly true, as will be seen later on, because the meaning of any income statement cannot properly be understood except with reference to the balance sheet at the beginning and the end of the period. Simplified statement of Wall Street's method of appraising common stocks. Viewing the subject from another angle, we may say that the Wall Street method of appraising common stocks has been simplified to the following standard formula. 1. Find out what the stock is earning. This usually means the earnings per share as shown in the last report. 2. Multiply these per share earnings by some suitable coefficient of quality which will reflect A. The dividend rate and record, B. The standing of the company, its size, reputation, financial position, and prospects, C. The type of business. For example, a cigarette manufacturer will sell at a higher multiple of earnings than a cigar company. D. The temper of the general market. Bull market multipliers are larger than those used in bear markets. The foregoing may be summarized in the following formula. Price equals current earnings per share times quality coefficient. The result of this procedure is that in most cases the earnings per share have attained a weight in determining value that is equivalent to the weight of all the other factors taken together. The truth of this is evident if it be remembered that the quality coefficient is itself largely determined by the earnings trend, which in turn is taken from the stated earnings over a period. Earnings not only fluctuate but are subject to arbitrary determination. But these earnings per share, on which the entire edifice of value has come to be built, are not only highly fluctuating, but are subject also in extraordinary degree to arbitrary determination and manipulation. It will be illuminating if we summarize at this point the various devices, legitimate and otherwise, by which the per share earnings may, at the choice of those in control, be made to appear either larger or smaller. 1. By allocating items to surplus instead of to income, or vice versa. 2. By over or understating amortization and other reserve charges. 3. By varying the capital structure as between senior securities and common stock, Such moves are decided upon by managements and ratified by the stockholders as a matter of course. 4. By the use made of large capital funds not employed in the conduct of the business. Significance of the foregoing to the analyst. These intricacies of corporate accounting and financial policies undoubtedly provide a broad field for the activities of the securities analyst. There are unbounded opportunities for shrewd detective work, for critical comparisons, for discovering and pointing out a state of affairs quite different from that indicated by the publicized per-share earnings. That this work may be of exceeding value cannot be denied. In a number of cases, it will lead to a convincing conclusion that the market price is far out of line with intrinsic or comparative worth, and hence to profitable action based upon this sound foundation. But it is necessary to caution the analyst against overconfidence in the practical utility of his findings. It is always good to know the truth, but it may not always be wise to act upon it, particularly in Wall Street. And it must always be remembered that the truth that the analyst uncovers is, first of all, not the whole truth, and, secondly, not the immutable truth. The result of his study is only a more nearly correct version of the past. His information may have lost its relevance by the time he acquires it, or in any event by the time the marketplace is finally ready to respond to it. With full allowance for these pitfalls, it goes without saying, nonetheless, that security analysis must devote thoroughgoing study to corporate income accounts. It will aid our exposition if we classify this study under 3 headings, viz. 1. The accounting aspect. Leading question: what are the true earnings for the period studied? 2. The business aspect. Leading question: what indications does the earnings record carry as to the future earning power of the company? 3. The aspect of investment finance. Leading question: what elements in the earnings exhibit must be taken into account, and what standards followed in endeavoring to arrive at a reasonable valuation of the shares? Criticism and restatement of the income account. If an income statement is to be informing in any true sense, it must at least present a fair and undistorted picture of the year's operating results. Direct misstatement of the figures in the case of publicly owned companies is a rare occurrence. The Ivor-Kruger frauds revealed in 1932 partook of this character, but these were quite unique in the baldness as well as in the extent of the deception. The statements of most important companies are audited by independent public accountants, and their reports are reasonably dependable within the rather limited sphere of accounting accuracy. But from the standpoint of common stock analysis, these audited statements may require critical interpretation and adjustment, especially with respect to 3 important elements. 1. Non-recurrent profits and losses. 2. Operations of subsidiaries or affiliates. 3. Reserves. General observations on the income account. Accounting procedure allows considerable leeway to the management in the method of treating non-recurrent items. It is a standard and proper rule that transactions applicable to past years should be excluded from current income and entered as a charge or credit direct to the surplus account. Yet there are many kinds of entries that may technically be considered part of the current year's results, but that are nonetheless of a special and non-recurrent nature. Accounting rules permit the management to decide whether to show these operations as part of the income or to report them as adjustments of surplus. Following are a number of examples of entries of this type. 1. Profit or loss on sale of fixed assets. 2. Profit or loss on sale of marketable securities. 3. Discount or premium on retirement of capital obligations. 4. Proceeds of life insurance policies. 5. Tax refunds and interest thereon. 6. Gain or loss as a result of litigation. 7. Extraordinary write-downs of inventory. 8. Extraordinary write-downs of receivables. 9. Cost of maintaining non-operating properties. Wide variations will be found in corporate practice respecting items such as the foregoing. Under each heading, examples may be given of either inclusion in or exclusion from the income account. Which is the better accounting procedure in some of these cases may be a rather controversial question, but as far as the analyst is concerned, his object requires that all these items be segregated from the ordinary operating results of the year. For what the investor chiefly wants to learn from an annual report is the indicated earning power under the given set of conditions. That is, what the company might be expected to earn year after year if the business conditions prevailing during the period were to continue unchanged. On the other hand, as we shall point out later, all these extraordinary items enter properly into the calculation of earning power as actually shown over a period of years in the past. The analyst must endeavor also to adjust the reported earnings so as to reflect as accurately as possible the company's interest in results of controlled or affiliated companies. In most cases, consolidated reports are made so that such adjustments are unnecessary. But numerous instances have occurred in which the statements are incomplete or misleading because either, 1, they fail to reflect any part of the profits or losses of important subsidiaries, or 2, they include as income dividends from subsidiaries that are substantially less or greater than the current earnings of the controlled enterprises. The third aspect of the income account to which the analyst must give critical attention is the matter of reserves for depreciation and other amortization, and reserves for future losses and other contingencies. These reserves are subject in good part to arbitrary determination by the management. Hence, they may readily be overstated or understated, in which case the final figure of reported earnings will be correspondingly distorted. With respect to amortization charges, another and more subtle element enters, which may at times be of considerable importance, and that is the fact that the deductions from income, as calculated by the management based on the book cost of the property, may not properly reflect the amortization that the individual investor should charge against his own commitment in the enterprise. Non-recurrent items. Profits or losses from sale of fixed assets. We shall proceed to a more detailed discussion of these three types of adjustment of the reported income account, beginning with the subject of non-recurrent items. Profits or losses from the sale of fixed assets belong quite obviously to this category, and they should be excluded from the year's result in order to gain an idea of the indicated earning power based on the assumed continuance of the business conditions existing then. Approved accounting practice recommends that profit on sales of capital assets be shown only as a credit to the surplus account. In numerous instances, however, such profits are reported by the company as part of its current net income, creating a distorted picture of the earnings for the period. Examples. A glaring example of this practice is presented by the report of the Manhattan Electrical Supply Company for 1926. This showed earnings of $882,000 or $10.25 per share, which was regarded as a very favorable exhibit. But a subsequent application to list additional shares on the New York Stock Exchange revealed that out of this $882,000 reported as earned, no less than $586,700 had been realized through the sale of the company's battery business. Hence, the earnings from ordinary operations were only about $295,300, or about $3.40 per share. The inclusion of this special profit in income was particularly objectionable because in the very same year, the company had charged to surplus extraordinary losses amounting to $544,000. Obviously, the special losses belonged to the same category as the special profits, and the two items should have been grouped together. The effect of including the one in income and charging the other to surplus was misleading in the highest degree. Still more discreditable was the failure to make any clear reference to the profit from the battery sale either in the income account itself or in the extended remarks that accompanied it in the annual report. During 1931, the United States Steel Corporation reported special income of some $19,300,000. the greater part of which was due to profit on sale of fixed property, understood to be certain public utility holdings in Gary, Indiana. This item was included in the year's earnings and resulted in a final net income of $13 million. But since this credit was definitely of a non-recurring nature, the analyst would be compelled to eliminate it from his consideration of the 1931 operating results, which would accordingly register a loss of $6,300,000 before preferred dividends. United States Steel's accounting method in 1931 is at variance with its previous policy, as shown by its treatment of the large sums received in the form of income tax refunds in the 3 preceding years. These receipts were not reported as current income, but were credited directly to surplus. Profits from sale of marketable securities. Profits realized by a business corporation from the sale of marketable securities are also of a special character and must be separated from the ordinary operating results. Examples: the report of National Transit Company, a former Standard Oil subsidiary, for the year 1928 illustrates the distorting effect due to the inclusion in the income account of profits from this source. The method of presenting the story to the stockholders is also open to serious criticism. The consolidated income account for 1927 and 1928 may be found in the accompanying PDF. The increase in the earnings per share appeared quite impressive, but a study of the detailed figures of the parent company alone, as submitted to the Interstate Commerce Commission, would have revealed that $560,000 of the 1928 income was due to its profits from the sale of securities. This happens to be almost exactly equal to the increase in consolidated net earnings over the previous year. Allowing on the one hand for income tax and other offsets against these special profits, but on the other hand for probable additional profits from the sale of securities by the manufacturing subsidiary, it seems likely that all or nearly all of the apparent improvement in earnings for 1928 was due to non-operating items. Such gains must clearly be eliminated from any comparison or calculation of earning power. The form of statement resorted to by National Transit in which such profits are applied to reduce operating expenses is bizarre to say the least. The sale by the New York, Chicago, and St. Louis Railroad Company through a subsidiary of its holdings of Père Marquette stock in 1929 gave rise later to an even more extraordinary form of bookkeeping manipulation. We shall describe these transactions in connection with our treatment of items involving non-consolidated subsidiaries. During 1931, F.W. Woolworth Company included in its income a profit of nearly $10 million on the sale of a part interest in its British subsidiary. The effect of this inclusion was to make the per-share earnings appear larger than any previous year, when in fact they had experienced a recession. It is somewhat surprising to note that in the same year the company charged against surplus an additional tax accrual of $2 million, which seemed to be closely related to the special profit included in income. Reduction in the market value of securities should be considered as a non-recurring item in the same way as losses from the sale of such securities. The same would be true of shrinkage in the value of foreign exchange. In most cases, corporations charge such write-downs when made against surplus. The General Motors report for 1931 included both such adjustments, totaling $20,575,000 as deductions from income, but was careful to designate them as extraordinary and non-recurring losses. Methods used by investment trust in reporting sale of marketable securities. Investment trust statements raise special questions with respect to the treatment of profits or losses realized from the sale of securities and changes in security values. Prior to 1930, most of these companies reported profits from the sale of securities as part of their regular income, but they showed the appreciation on unsold securities in the form of a memorandum or footnote to the balance sheet. But when large losses were taken in 1930 and subsequently, they were shown in most cases not in the income account, but as charges against capital, surplus, or reserves. The unrealized depreciation was still recorded by most companies in the form of an explanatory comment on the balance sheet, which continued to carry the securities owned at original cost. A minority of investment trusts reduced the carrying price of their portfolio to the market by means of charges against capital and surplus. It may logically be contended that, since dealing in securities is an integral part of the investment trust business, the results from sales and even the changes in portfolio values should be regarded as ordinary rather than extraordinary elements in the year's report. Certainly, a study confined to the interest and dividend receipts less expenses would prove of negligible value. If any useful results can be expected from an analysis of investment trust exhibits, such analysis must clearly be based on the three items: investment income, profits or losses on the sale of securities, and changes in market values. It is equally obvious that the gain or shrinkage so computed in any one year is no indication whatever of earning power in the recurrent sense. Nor can an average taken over several years have any significance for the future unless the results are first compared with some appropriate measure of general market performance. Assuming that an investment trust has done substantially better than the relevant average, this is, of course, a prima facie indication of capable management. But even here it would be difficult to distinguish confidently between superior ability and luckier guesses on the market. The gist of this critique is twofold. One, the overall change in principal value is the only available measure of investment trust performance. But two, this measure cannot be regarded as an index of normal earning power in any sense analogous to the recorded earnings of a well-entrenched industrial business. Similar problem in the case of banks and insurance companies. A like problem is involved in analyzing the results shown by insurance companies and by banks. Public interest in insurance securities is concentrated largely upon the shares of fire insurance companies. These enterprises represent a combination of the insurance business and the investment trust business. They have available for investment their capital funds plus substantial amounts received as premiums paid in advance. Generally speaking, only a small portion of these funds is subject to legal restrictions as regards investment, and the balance is handled in much the same way as the resources of the investment trusts. The underwriting business as such has rarely proved highly profitable. Frequently it shows a deficit, which is offset, however, by interest and dividend income. The profits or losses shown on security operations, including changes in their market value, exert a predominant influence upon the public's attitude toward fire insurance company stocks. The same has been true of bank stocks to a smaller but nonetheless significant degree. The tremendous over-speculation in these issues during the late 1920s was stimulated largely by the participation of the banks, directly or through affiliates, in the fabulous profits made in the securities markets. Since 1933, banks have been required to divorce themselves from their affiliates, and their operations in securities other than government issues have been more carefully supervised and restricted. But in view of the large portion of their resources invested in bonds, substantial changes in bond prices are still likely to exert a pronounced effect upon their reported earnings. The fact that the operations of financial institutions generally, such as investment trusts, banks, and insurance companies, must necessarily reflect changes in security values makes their shares a dangerous medium for widespread public dealings. Since in these enterprises an increase in security values may be held to be part of the year's profits, there is an inevitable tendency to regard the gains made in good times as part of the earning power and to value the shares accordingly. This results, of course, in an absurd overvaluation to be followed by collapse and a correspondingly excessive depreciation. Such violent fluctuations are particularly harmful in the case of financial institutions because they may affect public confidence. It is true also that rampant speculation, called investment, in bank and insurance company stocks leads to the ill-advised launching of new enterprises, to the unwise expansion of old ones, and to a general relaxation of established standards of conservatism and even of probity. The securities analyst, in discharging his function of investment counselor, should do his best to discourage the purchase of stocks of banking and insurance institutions by the ordinary small investor. Prior to the boom of the 1920s, such securities were owned almost exclusively by those having or commanding large financial experience and mature judgment. These qualities are needed to avoid the special danger of misjudging values in this field by reason of the dependence of their reported earnings upon fluctuations in security prices. Herein lies also a paradoxical difficulty of the investment trust movement. Given a proper technique of management, these organizations may well prove a logical vehicle for the placing of small investors' funds. But considered as a marketable security dealt in by small investors, the investment trust stock itself is a dangerously volatile instrument. Apparently, this troublesome factor can be held in check only by educating or by effectively cautioning the general public on the interpretation of investment trust reports. The prospects of accomplishing this are none too bright. Profits through repurchase of senior securities at a discount. At times, a substantial profit is realized by corporations through the repurchase of their own senior securities at less than par value. The inclusion of such gains in current income is certainly a misleading practice, first, because they are obviously non-recurring, and, second, because this is at best a questionable sort of profit, since it is made at the expense of the company's own security holders. Example. A peculiar example of this accounting practice was furnished as long ago as 1915 by Utah Securities Corporation, a holding company controlling Utah Power and Light Company. The following income account illustrates this point. Year ended March 31, 1915. Earnings of Utah Securities Corporation, including surplus of subsidiaries accruing to it, $771,299. Expenses and taxes, $30,288. Net earnings, $741,011. Profit on redemption of 6% notes, $1,309,657. Income from all sources accruing to Utah Securities Corporation, $2,050,668. Deduct interest charges on 6% notes, $1,063,009. Combined net income for the year, $987,659. The foregoing income account shows that the chief earnings of Utah Securities were derived from the repurchase of its own obligations at a discount. Had it not been for this extraordinary item, the company would have failed to cover its interest charges. The widespread repurchases of senior securities at a substantial discount constituted one of the unique features of the 1931 to 1933 Depression years. It was made possible by the disproportion that existed between the strong cash positions and the poor earnings of many enterprises. Because of the latter influence, the senior securities sold at low prices, and because of the former, the issuing companies were able to buy them back in large amounts. This practice was most in evidence among the investment trusts. Examples. The International Securities Corporation of America, to use an outstanding example, repurchased in the fiscal year ending November 30, 1932, no less than $12,684,000 of its 5% bonds, representing nearly half of the issue. The average price paid was about $55, and the operation showed a profit of about $6 million, which served to offset the shrinkage in the value of the investment portfolio. In the industrial field, we note the report of Armour and Company for 1932. This showed net earnings of $1,633,000, but only after including in income a profit of $5,520,000 on bonds bought in at a heavy discount. Similarly, more than all of the 1933 net of Goodrich Rubber, United Drug, Bush Terminal Building Company, and others was ascribable to this non-recurring source. A like condition was disclosed in the report of United Cigar Whelan Stores for the first half of 1938. Observe, on the other hand, that some companies, for example Gulf State Steel Corporation in 1933, have followed the better practice of crediting this profit direct to surplus. A contrary result appears when senior securities are retired at a cost exceeding the face or stated value. When this premium involves a large amount, it is always charged against surplus and not against current income. Examples. As prominent illustrations of this practice, we cite the charge of $40,600,000 against surplus made by United States Steel Corporation in 1929 in connection with the retirement at 110 of $307 million of its own and subsidiaries' bonds. Also, the charge of $9,600,000 made against surplus in 1927 by Goodyear Tire and Rubber Company, growing out of the retirement at a premium of various bond and preferred stock issues and their replacement by new securities bearing lower coupon and dividend rates. From the analyst's standpoint, either profit or expense in such special transactions involving the company's own securities should be regarded as non-recurring and excluded from the operating results in studying a single year's performance. A comprehensive example. American Machine and Metals, Inc., successor to Manhattan Electrical Supply Company mentioned earlier in this chapter, included in its current income for 1932 a profit realized from the repurchase of its own bonds at a discount. Because the reports for 1931 and 1932 illustrate to an unusual degree the arbitrary nature of much corporate accounting, we reproduce herewith in full the income account and the appended capital and surplus adjustments. This may be found in the accompanying PDF. We find again in 1932, as in 1926, the highly objectionable practice of including extraordinary profits in income while charging special losses to surplus. It does not make much difference that in the later year the nature of the special profit, gained through repurchase of bonds at less than par, is disclosed in the report. Stockholders and stock buyers for the most part pay attention only to the final figure of earnings per share as presented by the company, nor are they likely to inquire carefully into the manner in which it is determined. The significance of some of the charges made by this company against surplus in 1932 will be taken up later under the appropriate headings. Other non-recurrent items. The remaining group of non-recurrent profit items is not important enough to merit detailed discussion. In most cases, it is of minor consequence whether they appear as part of the year's earnings or are credited to surplus where they properly belong. Examples. Gimbel Brothers included the sum of $167,660, proceeds of life insurance policies, in income for 1938, designating it as a non-trading item. On the other hand, United Merchants and Manufacturers, receiving a similar payment of $1,579,000 in its 1938 fiscal year, more soundly credited it to surplus, although it had sustained a large loss from operations. Bendix Aviation Corporation reported as income for the year 1929 the sum of $901,282 received in settlement of a patent suit, and again in 1931 it included in current earnings an amount of $242,656 paid to it as back royalties collected through litigation. The 1932 earnings of Gulf Oil Corporation included the sum of $5,512,000, representing the value of oil previously in litigation. By means of this item, designated as non-recurrent, it was able to turn a loss of $2,768,000 into a profit of $2,743,000. Although tax refunds are regularly shown as credits to surplus only, the accumulated interest received thereon sometimes appears as part of the income account. For example, $2 million reported by E.I. DuPont de Nemours and Company in 1926, and an unstated but apparently much larger sum included in the earnings of United States Steel for 1930. Chapter 32. Extraordinary losses and other special items in the income account. The question of non-recurrent losses is likely to create peculiar difficulties in the analysis of income accounts. To what extent should write-downs of inventories and receivables be regarded as extraordinary deductions not fairly chargeable against the year's operating results? In the disastrous year 1932, such charge-offs were made by nearly every business. The accounting methods used showed wide divergences, but the majority of companies spared their income accounts as much as possible and subtracted these losses from surplus. On the other hand, the milder inventory losses of the 1937 to 1938 recession were almost universally charged into the earnings statement. Inventory losses are directly related to the conduct of the business and are, therefore, by no means extraordinary in their general character. The collapse of inventory values in 1931 to 1932 might be considered extraordinary in its extent, in the same way as the business results as a whole were exceptional. It follows from this reasoning that if the 1931 to 1932 results are taken into account at all, for example, in computing a long-term average, all losses on inventories and receivables must be considered part of the operating deficit of those years, even though charged to surplus. In Chapter 37, we shall consider the role of extraordinary years in determining the average earning power. Manufactured earnings. An examination of the wholesale charges made against surplus in 1932 by American Machine and Metals suggests the possibility that excessive provision for losses may have been made in that year with the intention of benefiting future income accounts. If the receivables and inventories were written down to an unduly low figure on December 31, 1932, this artificially low cost price would give rise to a correspondingly inflated profit in the following years. This point may be made clear by the use of hypothetical figures as follows. Assume fair value of inventory and receivables on December 31, 1932 to be $2 million. Assume profit for 1933 based on such fair value, $200,000. But assume that, by special and excessive charges to surplus, the inventory and receivables have been written down to $1,600,000. Then the amounts realized therefrom will show a correspondingly greater profit for 1933, which might mean reported earnings for 1933 of $600,000. This would be 3 times the proper figure. The foregoing example illustrates a whole set of practices that constitute perhaps the most vicious type of accounting manipulation. They consist, in brief, of taking sums out of surplus or even capital and then reporting these same sums as income. The charge to surplus goes unnoticed. The credit to income may have a determining influence upon the market price of the securities of the company. We shall later point out that the conservative writing down of the property account has precisely this result, in that it permits a decreased depreciation charge and hence an increase in the apparent earnings. The dangers inherent in accounting methods of this sort are the more serious because they are so little realized by the public, so difficult to detect even by the expert analyst, and so impervious to legislative or stock exchange correction. The basing of common stock values on reported per-share earnings has made it much easier for managements to exercise an arbitrary and unwholesome control over the price level of their shares. Whereas it should be emphasized that the overwhelming majority of managements are honest, it must be emphasized also that loose or purposive accounting is a highly contagious disease. Reserves for inventory losses. The accounting for inventory losses is frequently complicated by the use of reserves set up before the loss is actually realized. These reserves are usually created by a charge to surplus on the theory that it is a function of the surplus account to act as a sort of contingency reserve to absorb unusual future losses. If later the inventory shrinkage actually takes place, it is naturally charged against the reserve already created to meet it. The result is that in no year does the income account reflect the inventory loss. although it is just as much a hazard of operations as a decline in selling prices. When a company charges inventory losses to surplus, whether directly or through the intermediary of a reserve device, the analyst must take this practice carefully into account, especially in comparing the published results with those of other companies. A good illustration of this rule is afforded by a comparison of the reports submitted by United States Rubber Company and by Goodyear Tire and Rubber Company for the years 1925 to 1927, during which time rubber prices were subject to wide fluctuations. In these 3 years, Goodyear charged against earnings a total of $11,500,000 as reserves against decline of raw material prices. Of this amount, one half was used to absorb actual losses sustained, and the other half was carried forward into 1928, and eventually used up in 1930. United States Rubber during this period charged a total of $20,446,000 for inventory reserves and write-downs, all of which was absorbed by actual losses taken. But the form of annual statement, as submitted to the stockholders, excluded these deductions from income and made them appear as special adjustments of surplus. In 1927, moreover, the inventory loss of $8,910,000 was apparently offset by a special credit of $8 million from the transfer of past earnings of the crude rubber producing subsidiary. The result of these divergent bases of reporting annual income was that the per-share earnings of the two companies, as compiled by the statistical manuals, made an entirely misleading comparative exhibit. The following per-share earnings are taken from Poor's Manual for 1928. Year 1925, U.S. Rubber, $14.92, Goodyear, $9.45. Year 1926, U.S. Rubber, $10.54, Goodyear, $3.79. Year 1927, U.S. Rubber, $1.26, Goodyear, $9.02. 3-year average, U.S. Rubber, $8.91, Goodyear, $7.42. For proper comparative purposes, the statements must manifestly be considered on an identical basis or as close thereto as possible. Such a comparison might be made by 3 possible methods, viz. 1. As reported by United States Rubber, that is, excluding inventory reserves and losses from the current income account. 2. As reported by Goodyear, that is, reducing the earnings of the period of high prices for crude rubber by a reserve for future losses and using this reserve to absorb the later shrinkage. 3. Eliminating such reserves as an arbitrary effort of the management to level out the earnings. On this basis, the inventory losses would be deducted from the results of the year in which they were actually sustained. The Standard Statistics Company's analysis of Goodyear includes a revision of the reported earnings in conformity with this approach. We have, then, for comparative purposes, 3 statements of the per-share earnings for the period. This may be found in the accompanying PDF. The range of market prices for the 2 common issues during this period suggests that the accounting methods followed by United States Rubber served rather effectively to obscure the unsatisfactory nature of its results for these years. More recently, United States Rubber has followed the Goodyear practice of taking out of the earnings of prosperous years a reserve for future inventory shrinkage. As a result of this policy, the company somewhat understated its earnings for 1935 and 1936, but overstated them for 1937. A more recent contrast. The packing industry supplies us with a more extreme divergence in the method used by 2 companies to handle the matter of probable future inventory losses. Wilson & Company set up a reserve of $750,000 prior to the beginning of its 1934 fiscal year for fluctuation in inventory valuation. This was taken partly from surplus and partly from income. In 1934, it reduced its opening inventory by this reserve, thus increasing the year's reported profit by $750,000. The SEC, however, required it to amend its registration statement so as to credit this amount to surplus and not to income. On the other hand, Swift & Company reduced its reported earnings in the fiscal years 1933 to 1935 by $16,767,000, which was set up as a reserve for future inventory decline. In 1938, the expected decline occurred, but instead of drawing on this reserve to spare the income account, the company charged the full loss against the year's operations and then transferred $11 million of the reserve directly to surplus. In this exceptional case, the net income for the 6-year period 1933 to 1938 was understated, since amounts were actually taken out of income and turned over to surplus. Other elements in inventory accounting. The student of corporate reports must familiarize himself with two permissible variations from the usual accounting practice in handling inventories. As is well known, the standard procedure consists of taking inventory at the close of the year at the lower of cost or market. The cost of goods sold is then found by adding purchases to the opening inventory and subtracting the closing inventory valued as described. Last in, first out. The first variation from this method consists of taking as the cost of goods sold the actual amount paid for the most recently acquired lots. The theory behind this method is that a merchant's selling price is related mainly to the current replacement price or the recent cost of the article sold. The point is of importance only when there are substantial changes in unit values from year to year. It cannot affect the aggregate reported profits over a long period, but only the division of results from one year to another. It may be useful in reducing income tax by avoiding alternations of loss and profit due to inventory fluctuations. The normal stock or basic stock inventory method. A more radical method of minimizing fluctuations due to inventory values has been followed by a considerable number of companies for some years past. This method is based on the theory that the company must regularly carry a certain physical stock of materials and that there is no more reason to vary the value of this normal stock from year to year because of market changes than there would be to vary the value of the manufacturing plant as the price index rises or falls and to reflect this change in the year's operations. In order to permit the base inventory to be carried at an unchanging figure, the practice is to mark it down to a very low unit price level, so low that it should never be necessary to reduce it further to get it down to current market. As long ago as 1913, National Lead Company applied this method to the three principal constituents of its inventory, viz., lead, tin, and antimony. The method was subsequently adopted also by American Smelting and Refining Company and American Metals Company. Some of the New England cotton mills had followed a like policy prior to the collapse in the cotton market in 1930 by carrying their raw cotton and work in process at very low base prices. In 1936, the Plymouth Cordage Company adopted the normal stock inventory method after following a somewhat similar policy in 1933 to 1935, and for purpose of concrete illustration, we supply the relevant data for this company covering the years 1930 to 1939, found in the accompanying PDF. Idle plant expense. The cost of carrying non-operating properties is almost always charged against income. Many statements for 1932 earmarked substantial deductions under this heading. Examples. Youngstown Sheet and Tube Company reported a charge of $2,759,000 for maintenance expense, insurance and taxes of plants, mines, and other properties that were idle. Stewart Warner Corporation followed the exceptional policy of charging against surplus in 1932, instead of income, the sum of $309,000 for depreciation of plant facilities not used in current year's production. The 1938 report of Botany Worsted Mills contained a charge against income of $166,732, picturesquely termed cost of idleness. The analyst may properly consider idle plant expense as belonging to a somewhat different category from ordinary charges against income. In theory, at least, these expenses should be of a temporary and therefore non-recurring type. Presumably, the management can terminate these losses at any time by disposing of or abandoning the property. If, for the time being, the company elects to spend money to carry these assets along in the expectation that future value will justify the outlay, it does not seem logical to consider these assets as equivalent to a permanent liability. That is, as a permanent drag upon the company's earning power, which makes the stock worth considerably less than it would be if these assets did not exist. Example. The practical implications of this point are illustrated by the case of New York Transit Company, a carrier of oil by pipeline. In 1926, owing to new competitive conditions, it lost all the business formerly carried by its principal line, which thereupon became idle plant. The depreciation, taxes, and other expenses of this property were so heavy as to absorb the earnings of the company's other profitable assets, consisting of a smaller pipeline and high-grade bond investments. This created an apparent net loss and caused the dividend to be passed. The price of the stock accordingly declined to a figure far less than the company's holdings of cash and marketable securities alone. In this uncritical appraisal by the stock market, the idle asset was considered equivalent to a serious and permanent liability. In 1928, however, the directors determined to put an end to these heavy carrying charges and succeeded in selling the unused pipeline for a substantial sum of money. Thereafter, the stockholders received special cash distributions aggregating $72 per share, nearly twice the average market price for 1926 and 1927, and they still retained ownership of a profitable business which resumed regular dividends. Even if no money had been realized from the idle property, its mere abandonment would have led to a considerable increase in the value of the shares. This is an impressive, if somewhat extreme, example of the practical utility of security analysis in detecting discrepancies between intrinsic value and market price. It is customary to refer with great respect to the bloodless verdict of the marketplace, as though it represented invariably the composite judgment of countless shrewd, informed, and calculating minds. Very frequently, however, these appraisals are based on mob psychology, on faulty reasoning, and on the most superficial examination of inadequate information. The analyst, on his side, is usually unable to apply his technique effectively to correcting or taking advantage of these popular errors, for the reason that surrounding conditions change so rapidly that his own conclusions may become inapplicable before he can profit by them. But in the exceptional case, as illustrated by our last example, the facts and the logic of the case may be sharply enough defined to warrant a high degree of confidence in the practical value of his analysis. Deferred charges. A business sometimes incurs expenses that may fairly be considered as applicable to a number of years following rather than to the single 12-month period in which the outlay was made. Under this heading might be included the following: organization expense, legal fees, etc., moving expenses, development expenses for new products or processes, also for opening up a mine, etc., discount on obligations sold. Under approved accounting methods, such costs are spread over an appropriate period of years. The amount involved is entered upon the balance sheet as a deferred charge, which is written off by annual charges against earnings. In the case of bond discount, the period is fixed by the life of the issue. Mine development expenses are similarly prorated on the basis of the tonnage mined. For most other items, the number of years must be arbitrarily taken, 5 years being a customary figure. In order to relieve the reported earnings of these annual deductions, it has become common practice to write off such expense applicable to future years by a single charge against surplus. In theory, this practice is improper, because it results in the understatement of operating expenses for a succeeding period of years, and hence in the exaggeration of the net income. If, to take a simple example, the president's salary were paid for 10 years in advance and the entire outlay charged against surplus as a special expense, it is clear that the profits of the ensuing period would thereby be overstated. There is the danger also that expenses of a character frequently repeated, for example, advertising campaigns or cost of developing new automobile models, might be omitted from the income account by designating them as deferred charges and then writing them off against surplus. Ordinarily, the amounts involved in such accounting transactions are not large enough to warrant the analyst making an issue of them. Security analysis is a severely practical activity, and it must not linger over matters that are not likely to affect the ultimate judgment. At times, however, these items may assume appreciable importance. Examples: the Kraft Cheese Company, for example, during some years prior to 1927, carried a substantial part of its advertising outlays as a deferred charge to be absorbed in the operations of subsequent years. In 1926, it spent about $1 million for advertising and charged only one-half of this amount against current income. But in the same year, the balance of this expenditure was deducted from surplus. And furthermore, an additional $480,000 was similarly written off against surplus to cancel the balance carried forward from prior years as a deferred charge. By this means, the company was able to report to its stockholders the sum of $1,071,000 as earned for 1926. But when, in the following year, it applied to list additional shares, it found it necessary to adopt a less questionable basis of reporting its income to the New York Stock Exchange, so that its profit for 1926 was restated to read $461,296 instead of $1,071,000. The 1932 report of International Telephone and Telegraph Company showed various charges against surplus aggregating $35,817,000, which included the following: write-off of certain deferred charges that have today no tangible value, although originally set up to be amortized over a period of years in accordance with accepted accounting principles, $4,655,696. Hudson Motor Car Company charged against surplus instead of income the following items, among others, during 1930 to 1931. 1930. Special adjustment of tools and materials due to development of new models, $2,266,000. 1931, reserve for special tools, $2 million. Rearrangement of plant equipment, $633,000. Special advertising, $1,400,000. In 1933, Hecker Products, then called Gold Dust Corporation, appropriated out of surplus the sum of $2 million as a reserve for the net cost of introduction and exploitation of new products. About three-quarters of this amount was expended in years 1933 to 1936, and the balance then transferred to general and contingency reserves. The effect of these accounting practices is to relieve the reported earnings of expenditures that most companies charge currently thereagainst, and that in any event should be charged against earnings in installments over a short period of years. Amortization of bond discount. Bonds are usually floated by corporations at a price to net the Treasury less than par. The discount suffered is part of the cost of borrowing the money, that is, part of the interest burden, and it should be amortized over the life of the bond issue by an annual charge against earnings included with the statement of interest paid. It was formerly considered conservative to write off such bond discounts by a single charge against surplus in order not to show so intangible an item among the assets on the balance sheet. More recently, these write-offs against surplus have become popular for the opposite reason, viz., to eliminate future annual deductions from earnings and in that way to make the shares more valuable. Example: Associated Gas and Electric Company charged against surplus in 1932 the sum of $5,892,000 for debt, discount, and expense written off. This practice has aroused considerable criticism in recent years both from the New York Stock Exchange and from the SEC. As a result of these objections, a number of companies have reversed their previous charge to surplus and are again charging amortization of bond discounts annually against earnings. Chapter 33. Misleading Artifices in the Income Account, Earnings of Subsidiaries. Flagrant example of padded income account. On comparatively rare occasions, managements resort to padding their income account by including items in earnings that have no real existence. Perhaps the most flagrant instance of this kind that has come to our knowledge occurred in the 1929 to 1930 reports of Park and Tilford, Inc., an enterprise with shares listed on the New York Stock Exchange. For these years, the company reported net income as follows. 1929, $1,001,130 equals $4.72 per share. 1930, $124,563 equals 57 cents per share. An examination of the balance sheets discloses that during these 2 years, the item of goodwill and trademarks was written up successively from $1 million to $1,600,000 and then to $2 million, and these increases deducted from the expenses for the period. The extraordinary character of the bookkeeping employed will be apparent from a study of the condensed balance sheets as of 3 dates, which may be found in the accompanying PDF. These figures show a reduction of $1,600,000 in net current assets in 15 months, or $1 million more than the cash dividends paid. This shrinkage was concealed by a $1 million write-up of goodwill and trademarks. No statement relating to these amazing entries was vouchsafed to the stockholders in the annual reports or to the New York Stock Exchange in subsequent listing applications. In answer to an individual inquiry, however, the company stated that these additions to goodwill and trademarks represented expenditures for advertising and other sales efforts to develop the business of Tintex Company, Inc., a subsidiary. The charging of current advertising expense to the goodwill account is inadmissible under all canons of sound accounting. To do so without any disclosure to the stockholders is still more discreditable. It is difficult to believe, moreover, that the sum of $600,000 could have been expended for this purpose by Park and Tilford in the 3 months between September 30th and December 31st, 1929. The entry appears, therefore, to have included a recrediting to current income of expenditures made in a previous period, and to that extent the results for the fourth quarter of 1929 may have been flagrantly distorted. Needless to say, no accountant's certificate accompanied the annual statements of this enterprise. Balance sheet and income tax checks upon the published earnings statements. The Park and Tilford case illustrates the necessity of relating an analysis of income accounts to an examination of the appurtenant balance sheets. This is a point that cannot be stressed too strongly in view of Wall Street's naive acceptance of reported income and reported earnings per share. Our example suggests also a further check upon the reliability of the published earnings statements, viz., by the amount of the federal income tax accrued. The taxable profit can be calculated fairly readily from the income tax accrual, and this profit compared in turn with the earnings reported to stockholders. The two figures should not necessarily be the same, since the intricacies of the tax laws may give rise to a number of divergences. We do not suggest that any effort be made to reconcile the amounts absolutely, but only that very wide differences be noted and made the subject of further inquiry. The Park and Tilford figures analyzed from this viewpoint supply the suggestive results as shown in the table on page 438, which may be found in the accompanying PDF. The close correspondence of the tax accrual with the reported income during the earlier period makes the later discrepancy appear the more striking. These figures eloquently cast suspicion upon the truthfulness of the reports made to the stockholders during 1927 to 1929, at which time considerable manipulation was apparently going on in the shares. This and other examples discussed herein point strongly to the need for independent audits of corporate statements by certified public accountants. It may be suggested also that annual reports should include a detailed reconciliation of the net earnings reported to the shareholders with the net income upon which the federal tax is paid. In our opinion, a good deal of the information relative to minor matters that appear in registration statements and prospectuses might be dispensed with to general advantage, but if in lieu thereof the SEC were to require such a reconciliation, the cause of security analysis would be greatly advanced. Another extraordinary case of manipulated accounting. An accounting vagary fully as extraordinary as that of Park and Tilford, though exercising a smaller influence on the reported earnings, was indulged in by United Cigar Stores Company of America from 1924 to 1927. The theory behind the entries was explained by the company for the first time in May 1927 in a listing application that contained the following paragraphs. The company owns several hundred long-term leaseholds on business buildings in the principal cities of the United States which, up until May 1924, were not set up on the books. Accordingly, at that time, they were appraised by the company and Messrs. F.W. LaFrentz and Company, certified public accountants of New York City, in excess of $20 million. The board of directors have, since that time, authorized every 3 months the setting up among the assets of the company a portion of this valuation and the capitalization thereof in the form of dividends payable in common stock at par on the common stock on the quarterly basis of 1.25% on the common stock issued and outstanding. The entire capital surplus created in this manner has been absorbed by the issuance of common stock at par for an equal amount and accordingly is not a part of the existing surplus of the company. No cash dividends have been declared out of such capital surplus so created. The present estimated value of such leaseholds using the same basis of appraisals as in 1924 is more than twice the present value shown on the books of the company. The effect of the inclusion of appreciation of leaseholds in earnings may be found in the accompanying PDF. In passing judgment on the inclusion of leasehold appreciation in the current earnings of United Cigar Stores, a number of considerations might well be borne in mind. 1. Leaseholds are essentially as much a liability as they are an asset. They are an obligation to pay rent for premises occupied. Ironically enough, these very leaseholds of United Cigar Stores eventually plunged it into bankruptcy. 2. Assuming leaseholds may acquire a capital value to the occupant, such value is highly intangible, and it is contrary to accounting principles to mark up above actual cost the value of such intangibles in a balance sheet. 3. If the value of any capital asset is to be marked up, such enhancement must be credited to capital surplus. By no stretch of the imagination can it be considered as income. 4. The $20 million appreciation of the United Cigar Stores leases took place prior to May 1924, but it was treated as income in subsequent years. There was thus no connection between the $2,437,000 appreciation included in the profits of 1927 and the operations or developments of that year. 5. If the leaseholds had really increased in value, the effect should be visible in larger earnings realized from these favorable locations. Any other recognition given this enhancement would mean counting the same value twice. In fact, however, allowing for extensions of the business financed by additional capitalization, the per-share earnings of United Cigar Stores showed no advancing trend. 6. Whatever value is given to leaseholds must be amortized over the life of the lease. If the United Cigar Stores investors were paying a high price for the shares because of earnings produced by these valuable leases, then they should deduct from earnings an allowance to write off this capital value by the time it disappears through the expiration of the leases. The United Cigar Stores Company continued to amortize its leaseholds on the basis of original cost, which apparently was practically nothing. The surprising truth of the matter, therefore, is that the effect of the appreciation of leasehold values, if it had occurred, should have been to reduce the subsequent operating profits by an increased amortization charge. 7. The padding of the United Cigar Stores income for 1924 to 1927 was made the more reprehensible by the failure to reveal the facts clearly in the annual reports to shareholders. Disclosure of the essential facts to the New York Stock Exchange was made nearly 3 years after the practice was initiated. It may have been compelled by legal considerations growing out of the sale to the public at that time of a new issue of preferred stock underwritten by large financial institutions. The following year, the policy of including leasehold appreciation in earnings was discontinued. These accounting maneuvers of United Cigar Stores may be fairly described, therefore, as the unexplained inclusion in current earnings of an imaginary appreciation of an intangible asset, the asset being in reality a liability, the enhancement being related to a previous period, and the proper effect of the appreciation, if it had occurred, being to reduce the subsequent realized earnings by virtue of higher amortization charges. The federal income tax check described in the Park and Tilford example will also give interesting results if applied to United Cigar Stores as shown in the table found in the accompanying PDF. Moral drawn from foregoing examples. A moral of considerable practical utility may be drawn from the United Cigar Stores example. When an enterprise pursues questionable accounting policies, all its securities must be shunned by the investor, no matter how safe or attractive some of them may appear. This is well illustrated by United Cigar Stores Preferred, which made an exceedingly impressive statistical showing for many successive years, but later narrowly escaped complete extinction. Investors confronted with the strange bookkeeping detailed above might have reasoned that the issue was still perfectly sound because, when the overstatement of earnings was corrected, the margin of safety remained more than ample. Such reasoning is fallacious. You cannot make a quantitative deduction to allow for an unscrupulous management. The only way to deal with such situations is to avoid them. Fictitious value placed on stock dividends received. From 1922 on, most of the United Cigar Stores common shares were held by Tobacco Products Corporation, an enterprise controlled by the same interests. This was an important company, the market value of its shares averaging more than $100 million in 1926 and 1927. The accounting practice of tobacco products introduced still another way of padding the income account, viz. By placing a fictitious valuation upon stock dividends received. For the year 1926, the company's earnings statement read as follows. Net income, $10,790,000. Income tax, $400,000. Class A dividend, $3,136,000. Balance for common stock, $7,254,000. Earned per share, $11. Market range for common, $117 to $95. Detailed information regarding the company's affairs during that period has never been published, the New York Stock Exchange having been unaccountably willing to list new shares on submission of an extremely sketchy exhibit. Sufficient information is available, however, to indicate that the net income was made up substantially as follows. Rental received from lease of assets to American Tobacco Company, $2,500,000. Cash dividends on United Cigar Stores Common, 80% of total paid, $2,950,000. Stock dividends on United Cigar Stores Common, par value $1,840,000, less expenses, $5,340,000, total $10,790,000. It is to be noted that tobacco products must have valued the stock dividends received from United Cigar Stores at about 3 times their face value. That is, at 3 times the value at which United Cigar charged them against surplus. Presumably, the basis of this valuation by tobacco products was the market price of United Cigar Store shares, which price was easily manipulated due to the small amount of stock not owned by tobacco products. When a holding company takes into its income account stock dividends received at a higher value than that assigned them by the subsidiary that pays them, we have a particularly dangerous form of pyramiding of earnings. The New York Stock Exchange, beginning in 1929, has made stringent regulations forbidding this practice. The point was discussed in Chapter 30. In the case of tobacco products, the device was especially objectionable because the stock dividend was issued in the first instance to represent a fictitious element of earnings, that is, the appreciation of leasehold values. By unscrupulous exploitation of the holding company mechanism, these imaginary profits were effectively multiplied by 3. On a consolidated earnings basis, the report of tobacco products for 1926 would read as follows. American Tobacco Company, lease income, less income tax, etc., $2,100,000. 80% of earnings on United Cigar Stores Common, $6,828,000. Total, $8,928,000. Class A dividend, $3,136,000. Balance for common, $5,792,000. Earned per share, $7.27. The reported earnings for tobacco products common, given as $11 per share, are seen to have been overstated by about 50%. It may be stated as a Wall Street maxim that where manipulation of accounts is found, stock juggling will be found also in some form or other. Familiarity with the methods of questionable finance should assist the analyst and perhaps even the public in detecting such practices when they are perpetrated. Subsidiary companies and consolidated reports. This title introduces our second general type of adjustment of reported earnings. When an enterprise controls one or more important subsidiaries, a consolidated income account is necessary to supply a true picture of the year's operations. Figures showing the parent company's results only are incomplete and may be quite misleading. As previously remarked, they may either understate the earnings by not showing all the current profits made by the subsidiaries, or they may overstate the earnings by failure to deduct subsidiaries' losses or by including dividends from subsidiaries in excess of their actual income for the year. Former and current practices. In earlier years, disclosure of subsidiaries' results was a matter of arbitrary election by management, and in many cases important data of this kind were kept secret. For some time prior to 1933, the New York Stock Exchange had insisted in connection with new listings that the results of subsidiaries be presented either in a consolidated statement or separately. But since passage of the 1934 Act, all registered companies are required to supply this information in their annual reports to the Commission, and therefore practically all follow the same procedure in their statements to stockholders. Degree of consolidation. Even in so-called consolidated statements, the degree of consolidation varies considerably. Woolworth consolidates its domestic and Canadian subsidiaries but not its foreign affiliates. American Tobacco consolidates only its wholly owned domestic subsidiaries. Most utilities now issue consolidated reports including all companies controlled by them, by ownership of a majority of the voting stock, and deduct the portion of the earnings applicable to others under the heading of minority interest. In the railroad field, results are rarely consolidated unless the subsidiary is both 100% owned and also operated as an integral part of the system. Hence, Atlantic Coast Line does not reflect its share of the results after dividends of Louisville and Nashville, which is 51% owned but separately operated. The same is true with respect to the 53% voting control of Wheeling and Lake Erie held by the Nickel Plate, New York, Chicago, and St. Louis Railroad Company. Allowance for non-consolidated profits and losses. It is now frequent procedure for industrial companies to indicate either in the income account or in a footnote thereto their equity in the profits or losses of non-consolidated subsidiaries after allowance for dividends. Examples. The 1938 report of American Tobacco Company showed by way of footnote that dividends received from non-consolidated subsidiaries exceeded their earnings by $427,000. Hercules Powder reported a similar figure of $257,514 for that year, in footnote form, whereas prior to 1937 it had included its share of the undistributed earnings of such affiliates under the heading Other Income. Railroad companies handled this matter differently. The Atchison, for example, now supplies full balance sheet and income account data of affiliates in an appendix to its own report, which continues to reflect only the dividends received from these companies. The analyst should adjust the reported earnings for the results of non-consolidated affiliates if this has not already been done in the income account and if the amounts involved are significant. The criterion here is not the technical question of control, but the importance of the holdings. Examples. On the one hand, it is not customary, nor does it seem worthwhile, to make such calculations with respect to the holdings of Union Pacific and Illinois Central and other railroads. These holdings, although substantial, do not bulk large enough to affect the Union Pacific common stock materially. On the other hand, the adjustment is clearly indicated in the case of the ownership of Chicago, Burlington, and Quincy stock by Northern Pacific and Great Northern, each holding less than a controlling interest, 48.6%. Similarly, the interest of DuPont in General Motors, representing about 23% of the total issue, is undoubtedly significant enough in its effect on the owning company to warrant adjustment of its earnings to reflect the results of General Motors. This is actually done by DuPont each year in the form of an adjustment of surplus to reflect the previous year's change in the book value of its General Motors holdings. The analyst would prefer, however, to make the adjustment concurrently and to include it in the calculated earnings of DuPont. The effect of such adjustments on the earnings of DuPont for 1929 to 1938 may be found in the accompanying PDF. The report of General Motors Corporation for 1931 is worthy of appreciative attention because it includes a supplementary calculation of the kind suggested in this and the previous chapter. That is, exclusive of special and non-recurring profits or losses and inclusive of General Motors' interest in the results of non-consolidated subsidiaries. The report contains the following statement of per-share earnings for 1931 and 1930. Earnings per share, including the equity in undivided profits or losses of non-consolidated subsidiaries. Year 1931, including non-recurrent items, $2.01. Excluding non-recurrent items, $2.43. Year 1930, including non-recurrent items, $3.25. Excluding non-recurrent items, $3.04. Suggested procedure for statistical agencies. Although this procedure may seem to complicate a report, it is in fact a salutary antidote against the oversimplification of common stock analysis which resulted from exclusive preoccupation with the single figure of per-share earnings. The statistical manuals and agencies have naturally come to feature the per-share earnings in their analyses of corporations. They might, however, perform a more useful service if they omitted a calculation of the per-share earnings in all cases where the company's reports appear to contain irregularities or complications in any of the following directions, and where a satisfactory correction is not practicable. 1. By reason of non-recurrent items included in income or because of charges to surplus that might properly belong in the income account. 2. Because current results of subsidiaries are not accurately reflected in the parent company's statements. 3. Because the depreciation and other amortization charges are irregularly computed. Special dividends paid by subsidiaries. When earnings of non-consolidated subsidiaries are allowed to accumulate in their surplus accounts, they may be used later to bolster up the results of a poor year by means of a large special dividend paid over to the parent company. Examples: such dividends, amounting to $11 million, were taken by the Erie Railroad Company in 1922 from the Pennsylvania Coal Company and Hillside Coal and Iron Company. The Northern Pacific Railway Company similarly eked out its depleted earnings in 1930 and 1931 by means of large sums taken as special dividends from the Chicago, Burlington, and Quincy Railroad Company, the Northern Express Company, and the Northwestern Improvement Company, the last being a real estate, coal, and iron ore subsidiary. The 1931 earnings of the New York, Chicago, and St. Louis Railroad Company included a back dividend of some $1,600,000 on its holdings of Wheeling and Lake Erie Railway Company prior preferred stock, only a part of which was earned in that year by the Wheeling Road. This device of concealing a subsidiary's profits in good years and drawing upon them in bad ones may seem quite praiseworthy as a method of stabilizing the reported earning power. But such benevolent deceptions are frowned upon by enlightened opinion, as illustrated by the more recent regulations of the New York Stock Exchange, which insist upon full disclosure of subsidiaries' earnings. It is the duty of management to disclose the truth and the whole truth about the results of each period. It is the function of the stockholders to deduce the normal earning power of their company by averaging out the earnings of prosperity and depression. Manipulation of the reported earnings by the management, even for the desirable purpose of maintaining them on an even keel, is objectionable nonetheless because it may too readily lead to manipulation for more sinister reasons. Distorted earnings through parent-subsidiary relationships. Examples are available of the use of the parent-subsidiary relationship to produce astonishing distortions in the reported income. We shall give two illustrations taken from the railroad field. These instances are the more impressive because the stringent accounting regulations of the Interstate Commerce Commission might be expected to prevent any misrepresentation of earnings. Examples: in 1925, Western Pacific Railroad Corporation paid dividends of $7.56 upon its preferred stock and $5 upon its common stock. Its income account showed earnings slightly exceeding the dividends paid. These earnings consisted almost entirely of dividends aggregating $4,450,000 received from its operating subsidiary, the Western Pacific Railroad Company. The year's earnings of the railroad itself, however, were only $2,450,000. Furthermore, its accumulated surplus was insufficient to permit the larger dividend that the parent company desired to report as its income for the year. To achieve this end, the parent company went to the extraordinary lengths of donating the sum of $1,500,000 to the operating company, and it immediately took the same money back as a dividend from its subsidiary. The donation it charged against its surplus, the receipt of the same money as dividends it reported as earnings. In this devious fashion, it was able to report $5 earned upon its common stock, when in fact the applicable earnings were only about $2 per share. In support of our previous statement that bad accounting practices are contagious, we may point out that the Western Pacific example of 1925 was followed by the New York, Chicago, and St. Louis Railroad Company, nickel plate, in 1930 and 1931. The details are briefly as follows. In 1929, nickel plate sold, through a subsidiary, its holdings of Paramarquette stock to Chesapeake and Ohio, which was under the same control. A profit of $10,665,000 was realized on this sale, which gain was properly credited to surplus. In 1930, nickel plate needed to increase its income, whereupon it took the $10,665,000 profit out of its surplus, returned it to the subsidiary's treasury, and then took $3 million thereof in the form of a dividend from this subsidiary, which it included in its 1930 income. A similar dividend of $2,100,000 was included in the income account for 1931. These extraordinary devices may have been resorted to for what was considered the necessary purpose of establishing a net income large enough to keep the company's bonds legal for trust fund investments. The result, however, was the same as that from all other misleading accounting practices, viz., to lead the public astray and to give those on the inside an unfair advantage. Broader significance of subsidiaries' losses. We have suggested in this chapter that security analysis must make full allowance for the results of subsidiaries, whether they be profits or losses. But the question may well be raised: is the loss of a subsidiary necessarily a direct offset against the parent company's earnings? Why should a company be worth less because it owns something, in this case, an unprofitable interest? Could it not at any time put an end to the loss by selling, liquidating, or even abandoning the subsidiary? Hence, if good management is assumed, must we not also assume that the subsidiary losses are at most temporary, and therefore to be regarded as non-recurring items rather than as deductions from normal earnings? This point is similar to that discussed in the previous chapter relative to idle plant expense, and similar also to the matter of unprofitable divisions of a business, to be touched upon later. There is no one simple answer to the questions that we have raised. Actually, if the subsidiary could be wound up without an adverse effect upon the rest of the business, it would be logical to view such losses as temporary, since good sense would dictate that in a short time the subsidiary must either become profitable or be disposed of. But if there are important business relations between the parent company and the subsidiary, for example, if the latter affords an outlet for goods, or supplies cheap materials, or absorbs an important share of the overhead, then the termination of its losses is not so simple a matter. It may turn out, upon further analysis, that all or a good part of the subsidiary's loss is a necessary factor in the parent company's profit. It is not an easy task to determine just what business relationships are involved in each instance. Like so many other elements